Here's the video for our last chapter of the semester. In previous chapters, we were studying federal income taxation. But here in chapter 12, we're going to cover state and local. Local meaning county or city entities, municipalities. And because there's possibly hundreds of counties, cities, and states, what we're covering here in chapter 12 is more of general concepts, some common rules that apply across the country, and not really specific detail for each state or each county or each city. Here it says that the main purpose of taxes is to raise revenue for the government. That's kind of obvious, but more so that's true for state and local type governments that have to work within their budget. They cannot really go into deficit spending, possibly under their state constitution or county rules or bylaws. Unlike the federal government that runs billions, maybe even trillions dollars of deficits and a national debt. And of course, raising revenue to offset expenditures is just one reason for taxes. Other reasons for taxes is to promote some type of social or environmental policy, or maybe stimulate the economy. Examples of that would be that Tax Cut and Job Act that reduced the tax rates to help stimulate the economy. Or if you want to promote some type of social welfare, maybe things like promoting health insurance or penalizing taxpayers that don't have health insurance. We're focusing on, again here in our course, business taxation. And we have in the past few chapters covered corporations and partnerships. In the case of corporations, they're tax-paying entities, but they could be doing business in more than one state. But typically there's one main state for each corporation, and that's called their state of domicile. It may not necessarily be the state in which they incorporate. For example, Delaware, maybe Nevada, are popular states to incorporate in. So in case there's some type of court case, they have a standing to use those states' courts to adjudicate their cases. But typically a domicile is where the business is headquarters, their main state they do business in, and they have their management and operations. Of course, they still can have operations in other states. And for those other states to tax the corporation, there has to be some kind of connection. And here we see the word nexus. Yeah, some type of business connection. So now it's legal for those states to tax a corporation that doesn't have their domicile in that state. And we're going to study two types of taxes. Here in this diagram, we're focusing on sales taxes, or possibly use tax, and not income tax or federal income tax that we had studied for all of the past semester. So we looking at goods, that's tangible personal property being sold, and probably within each state, and whether that state has a connection to the business. And if it's yes, and we'll talk about nexus in a few slides from now, and if we do have nexus, then the selling business, the selling corporation has to collect from the buyer the sales tax and remit it to that state government where the buyer is located. Now, if the business doesn't have nexus, so here we answer no, then there is still a tax, but the business is not going to collect the tax. It's up to the buyer in that state to pay their own, they call it now use tax, which is comparable to the sales tax over here, and then pay it over to their state government. Here in Hawaii, they don't even try to enforce this use tax for consumers who buy property from out of state. It's just so um, administratively not practical or very hard to enforce. But if you're living in a state like California, they try to enforce collecting this use tax by saying that any use tax that you owe, you should tack it on to the income tax return that you file every year. Here now we're talking about not sales tax, but state income tax. And we're going to see the starting point is the federal income tax that we've been talking about throughout the whole semester. But federal law and state laws are different. So we're going to make adjustments either to increase the taxable income or decrease the taxable income to get to our state taxable income amount. And then we're going to divide up that state taxable income into two parts. One is the main business income, and then the other types of income you may have. Really, to get this business income, all we do is subtract out of the state taxable income the non-business income, which could include things like investment income, um, rent, and maybe royalties. Okay, so all of these are then subtracted from the state taxable income to get the business type income. And then if you do business in more than one state, and those other states besides your domicile state has Nexus, we're going to have to divide up this business income among the states using this term called apportionment. We'll see different factors that come in terms of apportionment. As for the non-business income, probably all of this investment income will be allocated or assigned to, not apportioned, but assigned or allocated to the domicile state of the corporation. Rent income is probably going to be credited to the state that has the property being rented, and royalty income assigned to the state where the underlying, probably intangible asset is being used. So we then get the apportioned business income and we add the allocated non-business income to get the so-called state taxable income for each state as compared to the state base where we had adjusted the federal taxable income way out at the top of this formula. Then whatever your state taxable income is, we multiply it by the state rates. It could be graduated rates or just a flat rate to get the state tax for the year. Okay, so you can see it's a little bit more complicated than the sales tax that we saw in this previous slide here. But again, that's the two main taxes: sales taxes, or so-called use tax, and then the state net income tax. Net income meaning that you have gross income and you minus out deductions to get the taxable income. As for sales tax, you really don't subtract out any deductions. There may be some few like bad debt, but generally you don't subtract out deductions when you calculate out sales taxes. So let's go into detail for sales taxes. So our textbook main focus is sales taxes based upon selling tangible versus intangible, personal versus real property. Here in Hawaii, sales tax, or the so-called general excise tax, is subjecting this type of property, but also services are subject to the general excise tax. And I'll have a separate video talking about, again, the detail for Hawaii. And other states where you sell in, if they have Nexus with your company, can also tax those sales. So let's take a look at, well, let's go back and look at one detailed rule. Here it says businesses create sales with tax nexus when they have a physical presence. Physical presence means that you have something in that other state. Could be a person, could be property, and that makes it now connected to your business, to your entity. A business is required to collect sales tax from customers in a state only if it has sales nexus. So if they don't have nexus, that doesn't mean the tax disappears. It just kind of forces the buyer to report a so-called use tax and pay it on their own. So let's look at this example where we have K. Bailey Corporation that's in Texas, so that's their domicile. They sell rare books, and they also um, have activity in New Mexico. And the only thing they do is solicit sales through a so-called independent agent. This independent agent is not an employee of K. Bailey Corporation, yeah, but acts only as an agent. And they could be agents for other businesses. But because this agent is physically present in New Mexico, well, let's look at the question. Does K, our corporation, have New Mexico sales tax nexus? And if so, then you got to collect sales taxes and pay it over to New Mexico. And the answer is yes. They have physical presence through their agent, even though the agent's not an employee. So K has to collect and pay over the sales tax to New Mexico. Example 2, Perry Corporation, this time a Texas domicile, sells fly fishing equipment, and they sell now in Colorado through catalogs, through flyers, and of course through the internet. So does Perry have Colorado Nexus where they have to collect the sales tax and pay it over to the Colorado government? The answer is no. So Perry doesn't have to collect the sales tax, but the buyers technically have to pay that tax, again called a use tax, over to their Colorado government. Now, all of this has been decided in old cases. This last one called Quill. And just recently means in 2018, there's another Supreme Court case called Wayfair. I think this company sells home furnishings, typically online. And now, under this rule, and there's an update posted in our Laulima Chapter 12 resources folder that talks about Wayfair. Typically, many states now have nexus rules. They call it economic presence versus physical presence. If there's at least $100,000 of sales by that company within their state, or maybe 200 or more transactions done in their state per year. These are per year amounts. So if so, now those companies like Wayfair, I believe they're contesting with North Dakota, that they have to collect sales taxes for sales made in that state and pay it over to that government, even though there's no physical presence. So this is relatively new. It's not in the body of our Chapter 12, but there are supplemental information again posted in our Chapter 12 resources folder in Laulima talking about Wayfair. Now when you do your assignments for the Learn Smart practice problems, homework, and quiz, just base it upon what's in the textbook. I take it back. In the homework, you may have a problem on Wayfair with this 100,000 limit, and it may not cover 200 transactions, but refer to the 100,000 limit. So if you have 100,000 or more sales during the year in that state, that state has nexus. That company has nexus with that state, and they have to collect the sales tax and pay it over to that state government. Let's shift our tax now to income taxes. This is better called net income tax. Net meaning gross income minus deductions to get net taxable income. So again, we have to have some type of domicile state where we're headquarters. And then other states we do business in, if those other states have nexus, then they can tax us on our net income. Okay, so again, there's court cases on dealing with this. In fact, it's almost becoming like Wayfair now, where if you just sell at a high volume, it may now subject you to income taxes for that state. We're not quite there yet, but it's kind of moving in that direction. So let's take a look at what factors are used to determine if you have nexus right now. Okay, again, nexus. Um, it still has to be a fair amount being taxed and not just administratively dictated by the state. It usually has to go through their legislature and it has to be fair, or in this case, not discriminating against non-resident corporations versus the corporations that are domiciled in their state. And if you are subject to their income tax, of course, you have to file an income tax return for that year and pay over the tax. The question is now how much income, how much deductions can you claim for your activity in that state? To get Nexus, they typically look at some type of physical presence test. Physical presence could be people working for you in that state. It could be property, both personal and real property, even intangible property being utilized in that state. It mentions here though, if you sell, well, this is selling, sorry. If you sell personal property in that state, that doesn't necessarily make or give you nexus due to an exception in one of the laws. And that exception is this so-called Public Law 8627. If the only thing you do is sell personal property in that other state without any physical presence, then maybe you're not going to be subject to income taxes in that state. But you got to meet all the detailed rules here. Here it says you only thing you do in that other state is sell personal um, property. So if you sell intangible property, that may subject you to income taxes for that other state. If you sell real property, then definitely you're going to be subject to income tax in the state where the real property is located. They say that the only thing you can do in that other state is selling activity of personal tangible property. Let's see. Here it says those sales have to be approved by your probably domicile state. Also, you can just take orders, yeah, in that other state. And when you deliver the merchandise, it has to be by um, um, a delivery service. It shouldn't be by your own employees, your own delivery um, service. It has to be like the postal service or UPS or FedEx. Things like um, there's some exempted activity that still may qualify you for this exemption to be exempt from income taxes. But if you have other types of activity, like a service type activity connected to your sales, things like repair, installation, that's going to disqualify you from this 86 to 72 exemption and subject the company to income taxes in that non-domicile state. Let's take a look at an example. Mark Corporation, their domicile is looks like Colorado, and they sell uh, photocopiers. So what they do besides selling is also they have a comprehensive service versus selling merchandise for their large clients. So now they're selling in another non-domicile state, Utah. And let's see, they have no sales office, no inventory in Utah. So everything is just delivered to their Utah customers. The orders, sales orders are approved not in Utah but in Colorado. And again, they don't use their own company for delivery. Here, though, it says to be competitive with local copiers in Utah, Mark has its sales agents on site to supervise installation. Okay, that's a no-no, right? And training, again, possibly another no-no. They're doing more than selling in Utah. So the question is, does Mark have Utah income tax nexus? And the answer is yes, because they do more than sell. They do installation, they do training. That's now going to go beyond that exception for 86-72, and Mark has to file an income tax return for Utah. Now, how much income they report is another question when we talk about the allocation appropriation. Okay, example two. Mark sells this time copiers in Arizona, and they're doing this for the past 25 years. They approve orders in Colorado outside of Arizona, and they don't use anybody in their company for delivery. Now, one local sales representative won a large contract in the current year, that's in Arizona. To help facilitate the sale, Mark reduces its formal normal fee by 50%. This is for services by their design team back in Colorado. Again, services, yeah, not sale of just merchandise. And have them do an on-site visit. Now the services is done right in Arizona. Integrated the client's new center and equipment. Sounds like installation to me also. So does Mark have Arizona income and have to file an income tax for Arizona? This one is a little bit fuzzy. It depends on really the volume, and they use the Latin term de minimis. And if the activity is real small compared to the whole company, maybe they can be exempt from filing that Arizona return. And now the question is, what is de minimis? Yeah, what is too small? It's hard to say when you don't have the numbers in front of you, but typically if it doesn't influence a financial reader, it may be immaterial, and maybe de minimis might be close to that way of measuring relative size. There's other types of taxes besides sales taxes and net income taxes. So it mentions in our textbook um, there may be um, other taxes. I think it's Texas and Oregon, and again, um, non-income based. Um, well, let's look in the physical presence to determine how much of the taxes are going to be allocated to each state. So one factor is the amount of sales made in each state. In fact, now that Wayfair just looks at that to determine whether you're subject to sales taxes now, not income taxes for a specific state. So the more sales you make compared to the overall company sales, then more nexus you have with that state. How do we file by company? So if each company has to file a return, if they have nexus with a state, that's called separate return. But if the businesses, the companies are related, maybe they have to file a consolidated return here called unitary tax return. And the advantage of, at least from the government's point of view, of filing unitary is now that separate companies cannot manipulate prices to reduce the profit and reduce the income tax being paid. Whereas if you have to consolidate everything together, now you're looking at the true profit that's subject to income taxes. So we kind of saw this in the flow chart near the beginning of the slideshow to come out to a state's taxable income. Your starting point is typically the federal taxable income, and then we adjust that by either increasing or decreasing that federal taxable income for the state rules. Certain types of income is taxable to the state but tax-free to federal, and vice versa. Certain types of deductions are deductible by the state and not deductible by federal, and again vice versa. So all of that is either added or subtracted to the federal taxable income to get to the state tax base or state taxable income. And they kind of just give you some examples here, like federal interest, treasury bond interest is taxable to federal but tax-free to state. So you would be subtracting that from the federal taxable income to get the state tax base or state taxable income. So here's examples. The one we just talked about is this one right here, subtracting it out from the federal taxable income. So these would be added to the federal taxable income. These would be subtracted from the federal taxable income to get the state tax base or state taxable income. Then that state tax base has to be divided among the states. So that's where we have some type of, the word is apportionment. And there's a common formula accepted by most states that is utilized. So typically the income is not going to be double taxed by 2 or more states. Again, we separate the business portion from the non-business portion, and what we're doing is apportioning the business income. So the factors that come into play when you apportion that business income is the economic presence of a corporation in the state, basically the amount you sell to customers located in that state, or how much employees you have in that state based upon how much you pay them, and then the amount of property you have in that state that you own. Well, I shouldn't say even own, but you could even rent or lease. So all these three used to be, when I first got into taxation, each of these had equal weights, but more and more now they're putting more weight on this sales or economic presence. And the trend is maybe just only looking at that. Again, for sales taxes, we're looking at income taxes here, but for sales taxes, looks like Wayfair, that court case, is making this the biggest factor. And now it's kind of sliding into income taxes to be a bigger factor, maybe double than these other two here. So if you take a look at the sales made in that one state compared to the sales for the whole company in all the states, that fraction, that factor, is now used to allocate your sales state tax base. Okay, and again, you do the same thing for payroll and do the same thing for property. So here's the definition of sales. So taking a look at again, definition of sales, the first of the three. If a state doesn't have taxes, net income tax, then they use something called a throwback or thrown back rule, allocating that sales, where the sales is not subject to tax, to a state that generated the sale, that, let's say, where the item was shipped from, that is subject to tax. Sale of services may be used in calculating economic presence, but then we only going to tax the income based on net income and not necessarily just sales of services. So the second factor was employees. So we take a look at the gross amount being paid to all employees. That does not include payments to independent contractors acting as your agent. Here it says each employee's total pay has to be allocated to a single state. So if one employee does work for multiple states, you look at the state that has the largest amount of work being done by that employee, and all of that employee's pay is allocated to that one state. In the case of property, and that's the third factor, the big one would be any real estate located in that state, and then tangible personal property. Now, the amount assigned to the property is typically the historical original cost, not reduced by any accumulated depreciation. And you may need to average out during the year that beginning and ending cost amounts. If you lease property in a state, of course you don't own it, so it won't show up with any costs, but still you're going to assign a dollar amount to that lease property. Here it says to take the annual rent you pay and you multiply by a factor of 8, and whatever that answer is added to the other costs, average cost of property you own in that state. Okay, that was business income in the previous slides. Now, allocating or assigning non-business income to each state. Typically, the investment type income, interest and dividends, you assign it to the corporation state of domicile. In the case of rental income, you assign it to the state where the rental property is located. In the case of royalties, this might be a little bit more subjective one, is where the intangible property is being utilized. And these others typically follow where the property is located. So you get your business income and you multiply it by the apportionment factor, which could be an average of the 3 items we just saw. And you take your non-business income based upon what is allocated for each state that we saw in the previous slides. And the total, then your state taxable income, you multiply it by the state's tax rates, be it a flat rate or a graduated rate, to get the tax for the whole year. Again, there's maybe some other non-sales tax, non-income taxes charged by certain states. So typically when you say you have a business in Texas, Texas doesn't have an income tax, but businesses are subject to Texas's margin tax. I haven't seen this one, the Washington State Business and Occupation Tax. There's also certain fees that may be charged, franchise taxes that may be charged by certain states that we haven't covered in this chapter. Okay, so that's it for chapter 12. Again, I'll prepare a separate video going through some general rules for Hawaii income taxes, and also not the sales tax, but the general excise tax for Hawaii.